Hello and welcome to Chapter 4, Management Fraud and Audit Risk. So this chapter starts off by discussing exactly what management fraud is. And management fraud is an important consideration because it's going to affect how we go about conducting the audit. So it's something that we need to consider before we go too far down the planning path to determine in terms of determining exactly what audit procedures we're going to do to ensure that we obtain sufficient appropriate evidence so that we can render an opinion on the financial statements. We're going to spend a lot of this chapter talking about the audit risk model. And of the things that you will learn in this chapter, this is the most important. So in terms again of devoting your attention to specific topics within the chapter, the audit risk model is by far and away the most important because we use the audit risk model ultimately to determine what procedures we're going to perform and how many of those procedures we're going to perform and what time we're going to perform them. So the audit risk model is critical. We conclude by discussing an issue that's related to fraud and also related to the audit risk model, which is the idea of what is the auditor's responsibility related to illegal acts. So we talk about different types of illegal acts and what kind of assurance auditors provide regarding different types of illegal acts. So let's get started. So we're going to start this chapter again talking about just the process of how do we actually assess business risk? How does management assess business risk? And how does that relate to information risk? And we discussed information risk in chapter 1, and we said that information risk is the risk that the company's financial statements are going to be materially misstated. And that's an important consideration for the auditor because, again, that's our role in the process, is reducing that information risk for outside users. So, business risk. We've talked about this before, so I'm not going to spend too much time talking about it. Again, it's just the failure to meet objectives, and that can happen for a lot of different reasons. It could be that the company isn't well managed, that it has a poor location, there's unexpected competition. A number of different things affect business risk. And so management has to assess this as well, right? So the auditors obviously have to assess what risks are involved in the business, but management should be doing this as well. So they need to have some overall plans as well as some strategy or some methods to actually achieve those plans. And that relates to information risk. What is the risk that the financial statements will be materially misstated? If a company does not have good objectives, that is, that they can't identify important risks so that they can come up with plans to address those risks, then there's a higher likelihood that the company will fail. If there's a higher likelihood that the company will fail, then there's also a higher likelihood that the company's financial statements may be misstated. And they may be misstated because a lot of the accounting that goes into financial statements assumes that a company is going to stay in business, in which case using, say, historical cost accounting is not appropriate. But it also could be misstated because all of a sudden senior management who are creating the financial statements feel under pressure and they start intentionally misstating the financial statements. So there are a number of sources of risk. And if we think about a company, it needs to be devising strategies and objectives to be able to address issues in their economic and legal environment. And this is a two-pronged process, right? They obviously operate in some kind of predefined environment. So they work in a specific industry, say, and they have very specific competitors a specific customer base, certain regulations for a certain industry, and maybe even a certain investor base. Maybe it's all institutional investors, or it's the opposite, right? We have a lot of small investors. It depends on the company and exactly how their business operates. But that is not the only thing that affects what events and transactions are going to occur within a company. It also is dependent on their business processes. So, what kind of financing do they use? What kind of legal processes do they use? What is their distribution processes? What are their marketing processes? What are their manufacturing processes? Or maybe they're not even manufacturing anything. So, both of these things, both the overall environment that they operate in, as well as individual or idiosyncratic business processes, affect what kind of events and transactions occur within an entity. And those overall business risks ultimately make up what we would label inherent risks. They are risks that are not easily separated from the event or the transaction. So certain types of transactions and certain types of accounts that contain information about those transactions have different inherent risks. And that's just given the nature of the transaction or the account balance. So as the company then records those events and transactions in their accounting records, it's ultimately going to go through their accounting information system. And part of that information processing process involves these IT controls or other processes, other manual controls in terms of ensuring that these transactions are actually adequately recorded in the financial statements. And so from transactions that just occur, the company then summarizes those in the form of accounting journal entries, and they go through this process of ensuring that there are not material misstatements, whether that is due to error or fraud, and hopefully these are being picked up by the company's control. We then use the summary of all of this accounting information to create financial statements. And again, these financial statements, there is information risk associated with them, because there is the risk that both economic and legal factors as well as business processes have influenced the actual recording of the transactions. There's also a risk that the company's control system did not prevent or detect misstatements that entered into the accounting system. And so the company eventually develops these financial statements, and there's still a risk that they are not correct. And again, that is where the auditor steps in. And the auditor says, okay, we've got these financial statements. There's a certain level of information risk associated with them. What level of risk am I comfortable accepting with relation to whether the financial statements are materially misstated? And I have to design an audit in order to make sure that I obtain sufficient appropriate evidence so that I've adequately adjusted the audit risk down to my comfort level. So that's kind of abstract, but another way of saying that is, if I want to make really, really sure that information risk is low, then I'm going to set my audit risk as low, and I need to collect a lot of evidence. And specifically, I need to collect sufficient appropriate evidence to be able to substantiate my opinion in the auditor's report. So it needs to be able to support whatever conclusion I reach. Now, the company, as I said, is going to go through this process where they are going to do a risk assessment, and they are going to look at what are all the factors that affect the company itself. And so they're going to say, well, there could be a flood, there could be an earthquake, we see this potential competition. And then ultimately what they have to do is they have to go through and they have to address those risks. And so the book goes into talking about what an enterprise risk management model is and what it addresses. And an enterprise risk management system, ultimately, it's just a tool that managers use to assess risks. And not just to identify and assess the risk, but then what are the processes we're going to put in place? What are the steps that we're going to take to make sure that we address those risks? So the question that students have for me whenever they read this is, why do I care? Yeah, management does things, we understand that. Why does that matter? The reason why it matters is because management is involved in the day-to-day operations of the company. So they, as we've discussed before, they're going to have superior information about the company. And the better the company's management is at identifying risks and adjusting to those risks, the more likely the company is to be successful. And again, that affects the auditor because, as we've discussed, when a company fails, the auditor is likely to be sued. And even more than that, we're unlikely to be able to think of potential issues for the company at the same level as management. That is to say, we have lots of clients. We don't just have one client. And so we need to rely on the client's expertise in terms of identifying risks and responding to those risks rather than coming up with them on our own. Because chances are they're going to be better at it because they're dealing with the same firm every single day, whereas we may have several firms that we're thinking about and considering. So the short of it is, the better a company's management is at identifying and responding to risks, the less overall risk there is with auditing that entity. Because chances are they're going to put policies and procedures in place to ensure that material misstatements are either prevented or detected if they have not been prevented. So risk management processes by management is essential for the auditor because it reduces our risk. The next thing we're going to talk about are what are the auditor's risk responsibilities. So the first thing that we're going to talk about is audit risk, and we're going to get into this in a lot of depth when we talk about the audit risk model. So audit risk is the risk that the auditor will give an unqualified opinion on the misstated financial statements. So as I just alluded to, we want to make sure that that risk is very low. We don't want to have a high risk that we're going to issue an unqualified opinion if there is a misstatement in the financial statements. That is our overall most important consideration. We do not want to give the wrong opinion because, again, if we do, we open ourselves up to liability. Management fraud risks. This is the risk that management intentionally misstates the financial statements through fraudulent financial reporting. We also have the risk of errors that are unintentional or omissions of information. And our primary responsibility is to design procedures to provide reasonable assurance that frauds or errors, so this does not say errors, but both frauds or errors that are would materially misstate the financial statements are detected. So in terms of our audit report, this is very important that you guys know what our responsibility is in terms of the financial statements. and I want you guys to know this for the exam. The auditor is responsible for providing reasonable assurance that both errors and frauds that would materially misstate the financial statements are detected. So what we can't do is, if we issue the wrong report and we're being sued, say, well, it was fraud, so we wouldn't be able to find it. The auditing standards recognize the fact that frauds are more difficult to identify than errors, because frauds are probably going to be intentionally concealed versus errors are unintentional, so the person isn't going to try to conceal them. However, just because they're harder to detect does not mean that we are not providing assurance that they do not exist. And so since that's our primary function in terms of litigation, that's going to go a long way if we're unable to meet that burden. If we're not able to say that if there was an error or there was a fraud, that it was not material. So other important definitions related to fraud. Okay, well, what types of fraud do we have? Well, we have employee fraud, including larceny, or more commonly referred to as misappropriation of assets, defalcation, embezzlement. In terms of this course, this is not a law course, and this is not a forensic accounting course. These terms are generally used interchangeably. When you hear people discuss employee fraud and larceny, defalcation, embezzlement, it's all referring to misappropriation of assets. So that's one type of fraud. And if you stop and you take a step back, you could think that in terms of stakeholders, there's a lot of different areas where fraud could come from, right? It could come from the owners or managers through some kind of insider trading or related party transactions. It can come from customers who are shoplifting, who are doing false refunds, writing hot checks. It can come from employees who, again, are embezzling or getting kickbacks, or padding their payroll, creating fictitious employees. So all the different stakeholders that we can think of, there's possible fraud risks from all of them, right? And there's risk that we can be a victim of fraud, whether that be through fraudulent financial reporting or misappropriation of assets. So again, we're providing reasonable assurance that we will prevent, or that there are not that we will. We're providing reasonable assurance that we would be able to detect any errors or fraud that are material to the financial statements. So what are some types of errors and fraud that could occur? Well, there's obviously invalid transactions. So a transaction for something that didn't actually happen. There are valid transactions. So something actually did happen, but it hasn't been recorded. So if we think about these first two, you say, well, these sound familiar. These sound like things that we've discussed before. For this first one, invalid transactions are recorded. That is dealing with the occurrence assertion, right? Occurrence assertion says that only valid transactions have been recorded. For the second one, valid transactions are omitted from the accounts. The assertion that that's most closely associated with is completeness. If it was a valid transaction, it shouldn't be omitted. It should have been recorded. Similarly, unauthorized transactions are executed and recorded. That, again, looking at the occurrence assertion. Transaction amounts are inaccurate. The assertion that we would be talking about there is accuracy or valuation. Transactions are classified in the wrong account. Again, presentation and disclosure, or classification if we're using the ASB assertions. Transaction accounting and posting is incorrect. Same thing, classification or presentation and disclosure. And transactions are recorded in the wrong period. So this would be a cutoff issue or a completeness issue. So when we actually design our working papers and we're thinking about errors and frauds that can occur in a specific transaction cycle, this is how we're going to think of them. Uh, but we are also going to make sure and specify what assertion that the error or fraud is most closely associated with to make sure that we've adequately addressed all of the relevant assertions. So we've talked about misappropriation of assets. There's also the second type of or major type of fraud, which would be fraudulent financial reporting. And so this is influenced by a number of things: management's characteristics and influence, industry conditions, and operating characteristics and financial stability. So we'll go through each of these in turn. So first, management's characteristics. So management may have a motivation to engage in fraudulent reporting, and we can think of a number of different situations or circumstances that may lead to increased fraudulent financial reporting. But where you see it most often is when management's compensation is tied to a specific financial report metric, or when the company is doing poorly, or when there's increased or unexpected competition. So motivation to engage is a characteristic that we need to be aware of. We need to make sure that we understand, how is management compensated? What are the metrics that people are looking at? Because those are the metrics that they're likely to manipulate. Management decisions are dominated by an individual or a small group. If you go back and look at some of the biggest frauds that have occurred in terms of financial reporting, one of the commonalities that you find is that someone who was at a high ranking position within the company exerted a lot of influence on upper management. And so that's always a risk. When someone's, taking on too much, they're both performing work and reviewing their own work. There's always a risk that they're going to be engaging in fraud. Management fails to display an appropriate attitude about internal controls. A really good case study in this, if you want to actually watch a movie, is Enron, the Smartest Guys in the Room. If you have a chance to watch that documentary, they really do a good job of showing how the aggressive attitudes of upper management filtered down to the salespeople, or the people that were ultimately trying to enact these different policies that they were doing. And they actually have an audio recording of some of the Enron employees where they're shutting off power in California, and people are getting trapped in elevators and they're laughing about it, but they're talking about how much money they're going to get by doing this. And that's a good example of how upper management's attitude ultimately filters down to the lowest employee level, and how that can lead to really bad consequences. So management's attitude towards aggressive accounting, their attitudes towards controls, are an important consideration for auditors. Again, same thing I just said, attitudes towards financial reporting. And this is another one, and this is also addressed in that Enron documentary. Managers place too much emphasis on earnings projections. If they've said in a press release, earnings per share is going to be this number, that's an important metric that you need to keep an eye on, because you need to ask yourself, is it reasonable that they achieve that earnings projection? And there's a lot of different ways you can determine whether it's reasonable. You can look at what other analysts have said, you can look at what other companies in the industry have done, but you need to keep these in mind in terms of saying, okay, what is the likelihood that a fraud could occur? And if you're seeing multiple red flags, management has the motivation, they're dominated by one individual, they're very aggressive, and they place a lot of emphasis on earnings projections, the more of these signs that you see, the more likely it is that fraud may be occurring. Okay, management's characteristics, uh, other things. Non-financial management participates successfully in the selection of accounting principles or determination of estimates. So we should not see that the marketing manager is coming up with the accounting principles. That's not appropriate. They do not have the requisite training to make those kind of decisions. The company has high turnover in senior management. This is always risky because if nothing else, they're unfamiliar with the company's accounting, as well as the fact that they may not be able to adequately perform the internal control procedures that they're supposed to be performing. If there's just a history, so if they've done it in the past, that's another red flag. Managers and employees tend to be evasive. If you're asking questions and people are vague, people don't want to answer, people become aggressive when you ask them questions, those are all signals that they're doing something that they should not be doing. Because if they should have no vested interest in giving you the answer, they should just be forthcoming in terms of their answers. Managers engage in frequent disputes with auditors. So this is one of those things that we need to consider. And we talked about this in chapter 3 when we talked about discussions with predecessor auditors. But if we're always having issues with management, we may need to consider whether we want to continue on with that client. And even within a given audit, if we really feel like they're being evasive, we really feel like they're pushing the envelope on a lot of things, we may need to consider whether we need to withdraw from the engagement, because it's that big of a risk that even if we do a lot of work, we may not be able to fully mitigate the risk that they're engaging in fraudulent financial reporting. Industry conditions. So, these are macroeconomic kind of issues, like the company's profits lag behind other people in their industry. There's some kind of new requirement or legislation that's going to cost them a lot of money. So say I'm auditing an insurance company and then Obamacare comes out and it's like, well, are they going to be able to comply with these new regulations? The company's market is saturated due to fierce competition. This is a huge factor in terms of when fraudulent financial reporting occurs. What is one way that you can set yourself apart from your competitors? Well, if it's truly fierce competition, you're probably not going to be able to do it just on an operational basis alone. And so what some people start thinking then is, well, I can't do it through operations, maybe I can do it through manipulating the financial statements. Company's industry is declining, so the company is maybe going away, it's going out of business, or similarly, the company's industry is changing rapidly. Again, the more of these indicators that you see, the more likely it is that there is something going on with fraud. And then lastly, operating characteristics. So if the company does not have good internal controls, that's obviously an issue because, again, internal controls are there to prevent or detect material misstatements within the financial statements and the accounting records. The company is not able to generate cash from operations, and at least enough to ensure that they're going to be a going concern. So again, accounting is based on this idea that the company is going to be around in the future. If the company is not going to be around in the future, then all of a sudden the conventions that we use, such as historic cost accounting and fair market value and all these different things, are not appropriate. A more appropriate measure would be the liquidated value of the company. So if we're really concerned that a company is not going to be able to stay in business for the next year, then there's a greater likelihood that the company will engage in some kind of financial statement manipulation. And you might say, well, why would they do that? And the reason is, well, the reason why they might want to do it is because, one, they want to keep getting paid, right? They don't want the company to go out of business. And related to that, a lot of companies, in terms of their financing and different agreements they have with different entities, are required to have a certain amount of profitability. So, for example, they may have a big loan from a bank, and the bank has stipulations that if they do not have a certain level of profitability, if they don't have a certain level of liquidity, then the bank can seize all of their assets. So to delay that, what a company might do is manipulate the financial statements so that they're still in compliance with those agreements. So there's a pressure to obtain capital, which is related to what I just discussed. A bank is not going to give you a loan if it doesn't look like you're going to be able to stay in business. Or the company operates in a tax haven jurisdiction, which is always a little bit risky. But there are a number of other things. The company has difficult accounting, measurement, or presentation issues. And so this is dangerous on a couple levels. It's dangerous on the level that maybe they're wrong just because it's complex, but also it's an issue because the more complex something is, the more likely it is that you would make an error to begin with. So the company having difficult accounting and measurement and or presentation issues is a huge issue in terms of fraud risk factors. The company has significant transactions or balances that are difficult to audit. Hopefully this is obvious. And the company has unusual or related party transactions. And lastly, and this kind of goes back to that whole tone at the top thing, the company's accounting personnel are lax or inexperienced in their duties, which is going to increase the likelihood that a fraud is going on, because they wouldn't be able to catch it, particularly if they're inexperienced, or if they just don't care and they're just going through the motions, they won't be able to find it either. Okay, so that's just a general assessment of risk. What are the different types of frauds that can occur? What are some things we should look for that would indicate that fraud may be going on? And that dovetails nicely into this idea of the audit risk model. So again, I said that ultimately the auditor is given these financial statements, and we have to assess the risk that these financial statements have some kind of material misstatement within them. And so we need to settle on some kind of plan for addressing those risks. And it's going to be different from company to company. So the audit risk model gives us an elegant model to be able to think about all companies in a similar manner, because all companies are going to have these same characteristics or components. So let's go through and talk about this. So this is the model that your book gives you, which is DR equals AR over IR times CR, which is detection risk equals audit risk divided by inherent risk times control risk. A better way to conceptualize it, and the way I always write it whenever I encounter an audit risk model problem or I'm thinking about it, I write it in this manner. Audit risk equals detection risk times inherent risk times control risk. And the reason why I do that is because it's easier to see what the effect of one thing has on the other components. So for example, if I'm saying that detection risk is unchanged and inherent risk is unchanged, but I say control risk is going up, then I can see that this side of the equation is going up. Something has to happen over here. In this case, this would have to go up. So it's just easier in terms of the algebra to see what's going on. If I say that same thing over here and I say, okay, control risk is going up, what effect does that have on the audit risk? It's a lot more complicated to reason through what should happen to audit risk, because it's just not laid out as clearly. So this gives us a useful way to look at it algebraically. So this equation is no different than any other equation you've encountered in your life, right? So when you guys first took your Intro to Financial Accounting course, they gave you the assets equals liabilities plus equity. And there was nothing magical about that either. So what did they mean? They said, well, if assets are going up and liabilities are the same, then what has to happen? Equity has to go up. If liabilities are going up and equity is unchanged, then what has to happen to assets? So these algebraic relationships need to hold. That is to say, if I'm saying that this side is going up, then something over here has to equal and also go up. So there's an equal sign here for a reason. So it's just like any other equation you guys have ever encountered. You need to make sure that the math actually makes sense when you think about it. And we'll get more into that when we actually start working on the homework. But it's useful to think about now. This is an equation for a reason. So what do these different things mean? DR, again, is detection risk. AR, audit risk. Sometimes you'll see books refer to this as acceptable audit risk. I just call it audit risk to save myself the time. Inherent risk, IR, and CR is control risk. And one of the things that we'll see, you notice up here in this first equation that they gave us, IR times CR, this is referred to as the risk of material misstatement. And that's something that we discussed when we talked about the gas standards. We said that we need to identify and assess the risk of material misstatement. This is what they were talking about. We need to assess the inherent risk of the company and the transactions and accounts, and we need to assess the control risk within the company. As we'll discuss later, you can examine these components either separate or together. And so that's up to the auditor's judgment. Some people find it useful to do them together because it's hard to separate how risky an account is from the controls that are in place. So let's talk about each of these in turn. So first, detection risk. So detection risk is simply the risk of detection failure. In other words, it's the risk that the procedures that we perform will fail to detect material misstatements. And again, material being what a reasonable user of the financial statements would think is important. So in other words, what we would find would be greater than what we will call tolerable misstatement. So there's what tolerable misstatement represents is this idea that we're not saying that the financial statements are perfectly correct. We're not saying that there's no error either way. What we're saying is that they're reasonable. So they're not materially misstated. So there's some level of misstatement that we're willing to accept. So we're willing to say that maybe it's 50,000 too high or 50,000 too low, but there's some area that we feel comfortable saying, okay, as long as it's less than this, it's okay if it's off a little bit. And we'll talk about that more later. Detection risk is dependent on the other three factors. So if we go back and we look at this equation, notice that one of the detection risk is over here by itself. The reason why it's over here by itself is because you do not specify directly detection risk. You figure out what audit risk is, you assess the risk of material misstatement, and that spits out what detection risk is. So another way to say this is detection risk is calculated. That is, we don't determine it. It's based on the other three factors, and that's how we determine what detection risk is. Now, why is detection risk important? That's a question you might be asking, and you say, well, it's important because it determines how much evidence we need to accumulate. So it's going to tell us how much evidence we need to collect, and specifically, it's going to have an inverse relationship with evidence. So what do I mean by that? What I mean by that is if we want detection risk to go down, so we want less of a risk that we're not going to detect a misstatement, then the opposite has to be true of the evidence that we're going to need to collect. That is, evidence is going to have to go up. So if we want less of a risk that we're going to fail to detect something, we need more evidence. Hopefully that makes sense, that you would need more evidence if you want less risk. And the opposite is true. If we're okay with more of a risk that we won't detect something, we can collect less evidence. But there's always this inverse relationship between evidence and detection risk. So that's why it's important, because it's telling us how much we need to collect. So what are some factors that influence detection risk? Well, there and for some reason so the factors that could affect detection risk include sampling risk. So sampling risk are just those risks that are associated with the sample itself. So one of the things that can happen is we say, well, we need a certain amount of evidence. Then we go out and collect a sample and we perform some tests on it. Well, what can happen is the sample that we collect is not representative of the population. So for whatever reason, we got a biased sample. If that's the case, that's going to affect the detection risk. If we can also have non-sampling risk, which are those risks that are not associated with this sample specifically. So we go out and we collect a sample just as we did before. It's a representative sample, but we reach an inappropriate conclusion for a reason that's outside of the sample. So a good example is we actually collect a representative sample, but we have an inexperienced auditor who's looking at the information. And that inexperienced auditor is not able to identify important issues with the sample. That would be an example of non-sampling risk. We weren't able to detect something because of the person's qualifications or experience in terms of interpreting the sample or performing the specific procedures that we ask them to perform. So detection risk is affected by both sampling risk and non-sampling risk. It's also affected by the nature, the timing, and the extent of audit procedures. So remember, we've talked about this before. Nature refers to the effectiveness of the test. Timing is associated with when are we actually performing the test, and extent is dealing with the sufficiency of the procedures, or how many procedures we perform. So in terms of collecting sufficient appropriate evidence, appropriate is affected largely by the nature and the timing. Extent deals mostly with the sufficiency of the evidence that we collect. So here's an example of what we're talking about. If we want lower detection risk, which is we want less risk that we will fail to detect something, then we need to use more effective tests. We need to use them closer to year end, and we need to do more testing. Conversely, if we're okay with higher detection risk for whatever reason, we can use less effective tests. We can do them at interim dates as opposed to year end, and we can perform fewer tests. So again, whatever ends up being detection risk, because again, it's a calculated amount. It's determined based on what the other three factors are. Once we know what detection risk is, then we can say, okay, do we need a lower? Do we need a higher? If we need a lower, then we need to be thinking about all three of these things. What is the nature of the test that we're going to perform? What timing are we going to use? And what is the extent, or how many things are we going to actually look at? Okay, audit risk is acceptable risk. So audit risk is the risk that the auditor will incorrectly issue a clean opinion. So we're not worried about when we issue a clean opinion and we're right. We're worried about when we issue a clean opinion and we're wrong, because that is when we're going to be sued. So in this case, less risk implies that we want to be more certain. So again, the key word is acceptable risk. What are we going to be willing to accept? If we're less willing to accept risk, that means we need to be more certain that the financial statements are materially correct. This is also referred to as audit assurance, which is a level of assurance or overall assurance. It's the complement to audit risk. That is to say, if I say that I want to have a 5% audit risk. What I'm also saying is I want to have 95% assurance that I'm right. So they're complements of each other. And so that's how you guys should think of it. If the auditor is saying I want 1% acceptable audit risk, that means that they want to be 99% assured. Then we have inherent risk. So inherent risk is the account or transaction risk, and this is the risk of some misstatement before we think about controls. So high inherent risk means that whatever account or type of transaction we're talking about is incredibly risky. So factors that would affect the inherent risk: the dollar size of the account is going to affect the inherent risk. The liquidity within the account or transaction is going to affect liquidity, within the company. So, how liquid is the company, which there we're talking about, how much cash do they have on hand? What are the volume of transactions? What is the complexity of the transactions? So pensions and derivatives have higher inherent risk because they're just a higher risk that there's going to be mistakes, whether they're from errors or fraud in those types of transactions. New accounting pronouncements have or accounts or transactions associated with new accounting pronouncements are going to have higher inherent risk because people are just not going to be as familiar with the proper accounting treatment. And then lastly, subjective estimates. So any of those accounting estimates that rely a lot on management assumptions are going to have higher inherent risks than those accounts that are very objective, like interest expense. Interest expense is what it is. However, some of the valuation for derivatives is highly subjective. Then control risk, and this is, students seem to understand this the easiest. Control risk is the assessment of whether the misstatements would have been prevented or detected by the client's internal controls. So if we say that a company has high control risk, it means that they basically have ineffective controls. So factors that could affect control risk include the control environment. So again, tone at the top, the existence or lack thereof of controls. So if they just don't have controls in place, that's an issue in terms of control risk. That's going to increase control risk. Monitoring activities, so how active is the audit committee, the internal audit function, etc. And again, these two components together, inherent risk and control risk, can be evaluated together. And hopefully that makes sense to you guys why that is. Sometimes it's difficult for people to conceptualize how inherently risky an account is without first considering what their controls are. But they can be assessed either separately or together. But again, to follow GAS, we need to make sure that we are assessing both of them. So what is the process? So it's a three-step process. First, we need to set whatever audit risk we feel comfortable with. We then need to assess inherent risk, assess control risk, and ultimately solve for detection risk. So what do I mean by that? This needs to be done before we think of these. We don't want to set audit risk in response to inherent risk and control risk. There's some level that we're going to feel comfortable with. We need to do that first. In terms of assessing these are going to be dependent on what's actually going on at the client. That is to say, we don't set these. We assess them. So we go to the client, look at the accounts, look at what they've done, and say, okay, these accounts are more inherently risky than these accounts, and the client either has controls in place or they don't have controls in place. All we're doing is assessing what's actually occurring, but we are not coming up with those numbers per se. And then ultimately, again, we need to solve for detection risk, which is going to tell us how many procedures we need to perform. So here's a numeric example. Let's say that we set audit risk, and again, that's set by the firm at low. And low can be relative, right? You can say 0.05 is low, or you can say 0.01 is low, or you could say 0.001 is low. The point is, in general, audit risk is going to be low. Inherent risk again, it's going to depend on the account or the type of transaction we're talking about, but let's say that we say that it's high. So this is a really risky account. And then let's say that we assess control risk as, say, medium or medium high. So we go through and we look at their controls and say, the controls they have aren't that good or are not that effective. So then we can just solve for it, and we come up with 0.08, and so we say, well, that's kind of low, so we then assess detection risk as low. So what does this mean for the auditor? Well, we've said if this is low, so we want to make detection risk low, it's going to have an inverse relationship with the evidence we need to collect. So in this case, we'd have to collect more evidence than if this had come out and it was high or medium. So let's look at an illustration of what I'm talking about. So first, let's put all the components up there: inherent risk, control risk, audit risk, and then detection risk. And let's say that we're looking at the sales and collection cycle, and we say, it seems like the accounts that are involved in here have, a pretty good risk of being misstated because of errors and fraud. So we're going to set the inherent risk as medium, but let's say that they have a lot of controls in place, but they're not all effectively working, or they're not all designed very well. So we say controls are okay, and then we say, okay, well, but we still want our audit risk to be low. Well, the only way we can get to a low audit risk is if we do a certain amount of work. So then we would solve for, we have all three components, we can solve for planned detection risk. And we would do the same for each cycle. We could go through the acquisition and payment cycle and say, you know what, they have a lot of transactions or accounts that are really susceptible to errors and fraud, so we're going to say the inherent risk is high. And then we say, but they have really good controls. So the inherent risk is really high, but they have great controls around the acquisition and payment cycle. And again, we still want to keep our audit risk as low, so we need to, again, perform some level of work in terms of planned detection risk, in terms of collecting evidence. Payroll and personnel, we look at that and we say, this has a low. I mean, we can't really think of reasons why this would be misstated for specific accounts or this specific class of transactions. We also think that they have great controls in place, and we still want our acceptable audit risk to be low. Well, if we go through and throw that in, what this is saying is we would be okay with having higher detection risk. So what does that mean? Well, what that means is, in relation to this cycle, to the acquisition and payment cycle, and to the sales and collection cycle, in this case, we could get away with collecting less evidence than we would in these situations. Right? So let's stop and think about what we mean. Well, if planned detection risk is high, then that means that the planned evidence we need to collect would be the opposite. There would be an inverse relationship. So this would be low in terms of planned evidence. If we look at these two, if it's medium, then the evidence is probably medium. So if we're comparing medium evidence to a low level of evidence, we're going to have to do more work here. Now we say, well, why is that the case? If we look at C, it's not because of acceptable audit risk, because this is always low, right? The reason why we end up doing less work in this area than we do in this work is because this particular transaction cycle has both less risk inherently and it has better controls. So hopefully that makes sense, that if it's less risky and there's better controls, we don't have to collect as much evidence. Another thing to notice about this chart is that these things do not need to be the same. That is to say that we're going to assess each of these cycles independently. We don't have to consider what's going on in one cycle in terms of informing the other one. We can have low inherent risk in one cycle and high in another. So these are not always going to be the same. But similarly, I want you guys to notice that this is almost always low. And we can argue about what level of low, but it's not going to be acceptable to have really high overall acceptable audit risk in most situations, unless we're talking about an account that is clearly immaterial and unimportant to the financial statements. So in general, acceptable audit risk is always going to be low. It's just depending on how low it's going to be. And then a last question you may be asking yourself is, well, how did we determine this? How did you say, okay, you went low, low, and then all of a sudden this high just jumps out of nowhere? Where did this come from? Because in the first example, we use numbers. And the important thing to remember is auditors do not actually use numbers in here. And we could talk about all the mathematical reasons why you wouldn't want to use numbers. But they're not used typically in practice. What we're going to instead use are just these levels, low, medium, high, and we're going to use decision aids to help us determine what we're going to do. So if we look at this matrix, we have inherent risk in this column, we have control risk in this row, and then we're looking at the different levels, low, medium, or moderate, and high for each of them. And then based on the intersection of the two, it will tell us what our detection risk should be. So let's look at the extreme examples. So for example, low inherent risk, low control risk. Hopefully it makes sense to you that if the account or transaction is less inherently risky and it has better controls, so control risk is low, we're okay with having high detection risk, because high detection risk means that we can collect less evidence. Because again, there's an inverse relationship between detection risk and evidence. Conversely, if we look at the other extreme, if an account or transaction is really inherently risky and they have bad controls, that's going to say that detection risk needs to be low. Well, this is just the opposite of what happens over here. Because there's an inverse relationship, if detection risk is low, that means our evidence needs to be very high. And it's going to especially be high in comparison with over here. So hopefully that makes sense to you. If the account or transaction is inherently risky and the controls are bad, we're going to have to collect more evidence. We're going to have to do more stuff. So that's the relationship. This is how auditors are typically going to determine what detection risk is. Now, another question you might be asking is, where is audit risk? We see inherent risk here, we see control risk here, and we see detection risk in the middle. Where is audit risk? And if you think again about an equation, if something is constant in an equation, we don't really need to include it, right? Because it's going to have the same effect. So in this case, because audit risk is always going to be low, it's not going to affect these outcomes. So if you go back and look, we're not going to see situations where this is high. So because it's always the same, we don't need to include it in the matrix. Okay, so this is just a summary of what we talked about. Audit risk is going to be set by the auditor. It's going to be low or very low. The risk of material misstatement is going to be assessed by the auditor. So it depends on whether it's likely to, there's going to be a likely error in the financial statements. Control risk, is it likely that the client's controls are going to prevent or detect misstatements? And then ultimately, detection risk is calculated. But I also like this because it kind of more goes through exactly what the process is. And that is what the company does in terms of its strategies and objectives is going to affect this environment that it operates in, both in terms of the economic and legal and the business processes. And that's going to spit out ultimately what the inherent risks are for that company. In response to those inherent risks, the company is going to adopt controls. So it's going to say, okay, we need these controls in place to make sure that transactions are processed effectively. these two things are going to affect the overall information risk within the financial statements. What we then have to do is we have to come up with an auditor's report, and we are going to do that in part by responding to audit risk. In other words, we're going to determine what detection risk is based on our overall general propensity to have low audit risk and what's going on with the company to determine how much evidence we need to ultimately collect. So that's kind of the process. The company is making decisions. The decisions that the company has made have led to what the inherent risks are, what the control risks are, which affect the financial statements. The only thing that we're doing is we're saying, okay, we want less audit risk always, and so how much evidence are we going to collect? And that's always going to be a function of what's going on with the client. Okay, so other factors that affect inherent risk, and here we're talking at the macro level. First is the nature of the client's business. So what are the practices within the industry? Are there a lot of non-routine transactions? What is the makeup of the population? Audit experience. So makeup of the population, what I'm talking about is obviously a population that has a lot of transactions is going to have higher inherent risk than an account that only has, say, 2 transactions, because 2 transactions are really easy to tie down. Multiple transactions are less easy to tie down. Audit experience are also going to affect this. So if we've already audited the client, there's going to be less inherent risk. So initial versus repeat engagements. Also, prior audit results inform us in terms of what to look for or what accounts do have issues. So that's going to help us in terms of inherent risk. And then also the audit judgment required to correctly record balances and transactions. So that goes back to detection risk. If we have people who are inexperienced who are performing audit procedures, we should expect that they're less likely to detect errors. So audit experience is going to affect what inherent risk is. And then, as we've discussed throughout, the culture of the organization. Are they involved in a lot of related party transactions? Are we seeing a lot of those factors related to fraudulent financial reporting? So their industry is in decline and there's increased competition. And similarly, factors related to misappropriation of assets. Are there weak controls that would allow people to easily steal from the company? All of these things are going to affect our overall assessment of how inherently risky the company is. Okay, so different information sources. So then they start talking about analytical procedures, fraud brainstorming, inquiry related to fraud. So what are some information sources to find out about the company? Well, we can look at general business sources such as trade magazines and the company's own different press releases that they have released to the media. We also have sources from within the company. So for example, the board minutes are an important source of information because they're going to be talking about anything that is macro that applies to the entire company. And we're also going to have information of our own. So past audit information, other engagements for firms, say in the same industry, that we're going to have in terms of identifying things that we expect to see, things that we don't expect to see. So analytical procedures are something that we talked about, and these are basically reasonableness tests. So a really generic way to describe analytical procedures is we have some recorded account balance, and what we want to do is we want to assess how reasonable is the recorded balance in terms of what we would estimate the account balance to be. Why would we want to do that? Well, there's several reasons, but the most important of which is going to be its attention directing. So it's going to help us identify potential problem areas within the firm. It also gives us a way of having an organized approach. It gives us a starting place for examining the financial statements. So we could say, okay, well, we expected revenue to be this amount. It's not this amount. Maybe we need to put more resources at identifying what the issues are with revenue. So it's also going to help us describe financial activities. So it's going to help us identify unusual changes or relationships in the data, and it's also going to help us think about relevant questions, such as what could be wrong with these financial statements? What are legitimate reasons for them to be seeing these kind of results? And so in that way, we can start thinking about things like, okay, what is the company's cash flow analysis? You know, if we're seeing relationships that we don't expect to see and the company's not generating cash flow from operations, maybe this is indicative of fraud. So the steps that we're going to take in terms of analytical procedures is, first we need to develop an expectation. What do we expect to see? Define what we think a significant difference is. And so we want to do this again before we actually do the calculation to make sure that we're not fitting our differences based on what we actually find. And then we're going to calculate the difference, essentially, and investigate anything that's above what we have defined as a significant difference. And then ultimately, as we've discussed in the working papers, we need to document everything that we did. So what was our expectation? What was significant? What did we do? We went and investigated it. What did we find? What is our conclusion? We need to make sure and document that all in our working papers. So different stages of use. It's required to use analytical procedures in the planning phase, again, to help us direct our attention to what we need to look at. It can be used, as I said, in the substantive testing phase. So particularly for those accounts like depreciation expense and interest expense, where it's easy to figure out relationships. But again, it's also required in the final or review phase. So I want to make sure that you guys understand when it's required to use analytical procedures. Also required is audit fraud brainstorming sessions. So the purpose of these brainstorming sessions is to gain an understanding of issues with the client, how frauds could occur, what procedures could we perform that might detect fraud. It's also going to help set a proper tone for the engagement. So everyone who works on the engagement has to be involved in this fraud brainstorming process. And that's not to say that this is just going to go on at the beginning of the audit. These kind of discussions need to be going on throughout the entire engagement, not just at the beginning of the audit or not just at the end of the audit, but throughout. So we always need to be thinking about new evidence and how it may be indicative of fraud. Inquiries. So who are we going to ask about fraud? Management, obviously, audit committee, internal auditors are a good source, other people within the organization, and in fact we want to specifically make sure and talk to people who are not in the accounting department, who are not involved with financial reporting, to get an idea of what's going on in terms of fraud. We need to assess fraud risks. Again, what types of risks are there? What is the significance of those risks? What is the likelihood that it's actually going to occur? What is the pervasiveness of the risk? So pervasiveness speaks to how many different accounts or transaction cycles would it affect. And it's possible for some frauds to affect the entire company versus other frauds could be limited to a specific account or type of transaction. So what is the effect on the overall financial statement? And we need to assess as part of that, and we've already discussed this, the controls or programs they have in place to prevent or detect fraud. So required risk assessments, there's a presumption when you do an audit that there's some kind of fraud involving revenue. And we'll talk about this more when we get to chapter 7, but this is because this is by far and away the most common type of fraudulent financial reporting. It's always also assumed that management could intentionally misstate the financial statement by overriding controls. So that's an inherent limitation of internal controls, that management can override the controls. So we always need to assess the risk that management could override controls. So in general, we need to do some work where we're examining journal entries and other adjustments made by management to ensure that they're not overriding controls. We also need to review estimates that are made by management to look for biases, as well as when we see significant unusual transactions, we need to evaluate what was the business rationale for this weird transaction that doesn't occur very often. And ultimately, what we need to do is identify significant risks to the financial statements. Once we've identified those risks, we need to respond to those risks. So what are some ways we can respond to the risk? Well, we can assign more experienced personnel. If they're using aggressive accounting principles, we need to think about whether they should be using more conservative accounting principles. We need to consider incorporating unpredictability into auditing procedures that we're performing. So don't just do the same procedures at the same locations at the same time, mix things up, add new procedures, remove procedures, etc. Look at prior year estimates, compare them to current year estimates to look for reasonableness. And we also need to make sure and accumulate the results of everything that we find. So if we are finding errors in every single different type of transaction cycle that we look at, we need to look for trends in that. Are all these errors income increasing? Are they all income decreasing? And so we need to look at these kind of cumulative effects of things that we found. And we also need to consider performing extended procedures, particularly when we're finding things that we don't expect to see. Part of evaluating the audit evidence is looking for discrepancies in the accounting records, conflicting or missing evidential matter. That is an issue. Particularly if it's missing, we have to wonder why it's missing. Problematic or unusual relationships between the auditor and the manager. Results from substantive final review stage analytical procedures. So in other words, we've done all this other stuff. We get to the end, we reperform these analytical procedures, and we're seeing results that we don't expect to see. That may mean that we need to go back and do additional procedures. And as I've discussed before, vague, implausible, inconsistent responses to inquiry, evasive answers to inquiry, aggressive responses to inquiry. These are all things that we need to consider in terms of ultimately what we need to communicate to others within the organization, as well as ultimately what our audit opinion is going to be. So we need to communicate fraud matters to the appropriate level of management. What that means is we need to communicate to at least one level above wherever we find a fraud. So if we're auditing a retailer and we find fraud at the store level, we should tell the store manager. Unless the store manager is the one that's doing it, then we need to tell, say, the regional manager. And this is always the case until we talk about senior management, in which case if we find something with senior management, we need to report that to the audit committee. Sarbanes-Oxley requires that we communicate significant deficiencies and material weaknesses to those charged with governance, which is the board of directors. So if we're going through here and we're finding some of these unusual relationship or errors, we need to communicate to both management and ultimately the board of directors that, hey, your controls are not preventing or detecting these misstatements because we found a number of them. And lastly, any fraud committed by senior management, which are those people like the CEO, CFO, chief accounting officer, those are going to be material no matter how quantitatively small. So I gave you guys the example of you find out that the CEO is stealing $10 out of the petty cash account. That is material. And the reason why it's material is because, again, management can override controls. And so if they're dishonest about $10 worth of CAD money, then they're probably going to be dishonest about other things. So management integrity is an integral part of making sure that we can rely on the client's controls. But even if we're not relying on the client's controls, it also introduces the possibility that the financial statements have been manipulated. So it's always going to be material. And we ultimately need to document all of these fraud considerations. So the discussions we've had with personnel, the procedures we took, the risks that we identified and how we responded to those risks, what's going on with revenue recognition. If we think it's not a risk, we need to explain why, because again, it's presumed that it is an issue. The results of management override of controls, other conditions that we think additional procedures would be required, and all of the communications we've had with both management and the audit committee and others within and outside of the organization, including regulatory bodies, if that is appropriate. Okay, then in terms of laws and regulations, I'm not going to spend a ton of time talking about this, but laws and regulations are a separate consideration from fraud itself. So here we're talking about the company as a whole being engaged in violations of laws or regulation. So there's two different types that we could talk about. One is direct effect noncompliance. So this is a good example of that is a law or regulation, or the definition of that is a law or regulation that can be identified with a specific account or type of disclosure. So for example, if the company is involved with income tax evasion, that's going to have a direct effect on the financial statements in terms of income tax expense, right? So it directly applies to a specific line item on the financial statements. In terms of direct effect, we provide reasonable assurance. So the same as we do for errors and fraud. But we also have these indirect effect noncompliance, which are things that are not related to a specific account or any kind of disclosure. So some examples of those: insider trading, OSHA violations, FDA violations, and EPA violations, equal employment violations. Our responsibility for these, if they come to our attention, is to follow up on anything that is suspected to be material to the financial statements. So these can rise to the level of being material to the financial statements, right? If the company is drastically violating environmental standards, they may receive some kind of fine, and as a result of that fine, it may cause all kinds of liquidity problems and other problems for the company. So these can be material. Now, in terms of our responsibility, they're different. So for direct effect illegal acts, our responsibility is the same as it is for errors and fraud. We provide reasonable assurance. For indirect effect illegal acts or noncompliance, we provide no assurance. So there's a different level. Really, with indirect effect, we're only going to move forward with investigating those acts if something comes to our attention where we have reason to suspect that there has been some kind of indirect effect illegal act or noncompliance with regulations. But it's not the same level in terms of what we're looking for. We're primarily going to be looking for those direct effect illegal acts. So we provide no assurance of these indirect effects. So some red flags: if we're seeing unauthorized transactions, government investigations, regulatory reports, payments to affiliates or employees for unspecified reasons, excessive sales commissions, unusually large cash payments. And so these 3, we see a lot when people are violating, say, the Foreign Corrupt Practices Act, which is basically an act that says that U.S. companies can't bribe foreign officials. So one of the ways that companies get around that is they say, oh, I'm paying a consultant, or I'm paying this kind of thing. And so these are potential red flags for noncompliance with different regulations. Unexplained payments to government officials, failure to file tax returns or pay duties. These are all red flags in terms of, hey, should we be concerned about both direct effect and indirect effect illegal acts? And then lastly, an audit strategy memo. This is a memo that's going to precede that audit plan that we talked about, and it's basically going to set forth, what's going to happen with the audit. So we're going to identify significant accounts and transactions, establish an overall audit strategy, taking into account, what are the required communications, what is our risk assessment process, what are the laws or regulations that we're supposed to follow, when are we going to be able to actually do the work, what are the planned tests in terms of controls, in terms of substantive tests, in terms of other, say, fraud communications and procedures we're going to do. And ultimately, the memo is the basis for creating those audit programs that we said were required in Chapter 3. And again, a written audit plan documenting our overall audit strategy is going to be required for all audits. So this is Chapter 4. If you guys have any questions, again, make sure and contact me or post them on the discussion board. And look now for the answers to the homework from Chapter 4.